Passing the cottage to the next generation. Today, we're diving into a topic that hits home, literally. We're talking about how to pass down the family cottage to the next generation without it tearing your family apart. Welcome to the channel. My name is Anthony Gismondi. I'm a senior wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. Why cottage succession planning matters. For many families, the cottage isn't just real estate, it's the heart of summer memories. But without a proper plan, passing it on can cause more headaches than harmony. The tax trap, capital gains. Let's start with the big issue, capital gains tax. When a property was owned by two parents, mom and dad, and the surviving parent passes away, CRA treats it as if you sold the cottage at fair market value. Let's say you bought the cottage for $150,000 and now it's worth $750,000. That's a $600,000 capital gain, could lead to a major tax bill for your estate. But there are ways to plan ahead. One powerful option, life insurance. It provides a tax-free payout that your estate or your heirs can use to pay the tax bill, so they're not forced to sell the cottage. But insurance premiums can be high, especially if you're older or have health issues. That's why some families have their children help pay the premiums, since they'll be the ones who'll be benefiting. Another tool is the capital gains reserve. If you sell the cottage to your kids and take back a promissory note, if structured correctly, you may be able to spread the capital gains related to the disposition of the cottage over 5 taxation years. This softens the tax hit and keeps your income lower, which can help avoid things like OAS clawbacks. You can even forgive the balance of that note in your will if you choose. The family feud factor, dynamics, and disputes. Even close siblings can get into serious disputes over shared property. That's why emotional planning is just as important as tax planning. Questions you must answer as a family. Who gets to use the cottage and when? Who pays for maintenance and taxes? What happens if one sibling wants to sell their share? Strategy: set up a co-ownership agreement. Don't leave it to chance. Draft a co-ownership agreement. This legal document spells out everything. Usage schedules, financial responsibilities, decision-making rules, buyout terms, and dispute resolution. This protects relationships and the property. Use equalization measures. Let's say one child wants the cottage and the other doesn't. You can use equalization measures, like leaving more cash or investments to the other child, or using life insurance to keep things fair. This avoids resentment and preserves family harmony. Consider a trust. For more structured long-term planning, you might consider a cottage trust, either set up now, inter vivos, or as part of your will, testamentary. Why use a trust? Keeps the cottage in the family. It can include cash or investments to help fund taxes and repairs. Protects the cottage from your kids' creditors or divorcing spouses. But be aware, trusts come with setup and maintenance costs, and they're subject to a deemed disposition every 21 years, which can trigger capital gains tax. You'll want to make sure to discuss this with your tax professional to ensure you understand all the tax consequences of this type of planning. U.S. cottages and cross-border complications. If your cottage is in the U.S., you could be exposed to U.S. estate taxes, even as a Canadian resident. These can be significant, so you'll want to work with a cross-border tax expert. Final thoughts and key takeaways. There's no one-size-fits-all solution, but the worst plan is no plan at all. Here's what you should do. 1. Talk to your family. Be honest about your goals and expectations. 2. Work with pros. A financial advisor, tax expert, and estate lawyer are must-haves. 3. Put it in writing. Whether it's a co-ownership agreement, trust document, or an updated will. With careful planning, you can pass on more than just a piece of property. You can pass on a legacy your family will cherish for generations.